You know, back in 2008 to 2009, Burry accurately predicted the housing and stock market crash. But what's surprising is that instead of being applauded for his foresight, he faced harassment from the government and had to shell out $1 million in legal fees just to defend himself. Listen to him. And now here we are today, and it seems like history is repeating itself. This guy has a track record of predicting major financial disasters, and yet people are turning deaf ears. And here he is again with another prediction. In this video, we'll go into details about this, so you should stick around with us until the end. Listen before it's too late. The US and global economy are once again facing a significant threat, and it's becoming increasingly evident that something is seriously wrong. Regardless of whether all economists agree on the possibility of a recession, one thing is certain: the economy and stock market are showing signs of utter chaos and are likely to face turmoil for the foreseeable future. The lack of growth or even negative growth in corporate earnings is raising the likelihood of a global recession. Even JP Morgan, a major financial institution, has issued a warning that the market could plummet further, possibly by an additional 20% from its current levels. The recent erratic and unpredictable behavior of stock prices, with sharp declines followed by sudden rallies, only adds to the confusion and uncertainty. Amidst this uncertainty, Dr. Michael Burry stands out with his clear-cut prediction. Known for his contrarian views, he foresaw the subprime crisis before anyone else. Now, Burry is asserting that inflation will worsen and erase any gains that investors may have made in the market over the past few years. Shockingly, he believes that this is just the beginning, and there seems to be no end or bottom in sight. Let's delve into the current situation and explore why the stock market is experiencing a sell-off and the latest warning from Michael Burry. Analyzing the present trading environment, Burry cautions investors not to get their hopes up about any potential rallies in the upcoming winter quarter. He believes that any temporary recoveries will be short-lived and won't lead to a substantial market turnaround. Speaking of market rallies, they refer to a stock market increase of at least 5% during a bear market's downturn. Such rallies are commonly observed, and historical data from the bear market between 1901 and 2015 indicate that there were multiple instances of 5% rallies. Moreover, rallies of 10% were often interrupted, occurring in only 2/3 of the 21 bear markets during that time period. Given the current circumstances, it becomes evident that history tends to repeat itself. The severity of the decline directly influences the difficulty of the subsequent rebound. As exemplified by the 1929 crash, the Dow Jones experienced a significant surge of around 48% after plummeting by 86%. Similarly, during the dot-com market crash, there were 8 bear market rallies with gains of 18%, including 4 instances of nearly 30% gains, but they occurred after further declines. With that said, do you know that during the Great Financial Crisis of 2008, there were 9 bear market rallies before reaching the bottom after a couple of years? These rallies range from 6% to 24%, giving investors moments of hope amidst the turmoil. Speaking of bear market rallies, Michael Burry has an interesting observation. Since the market peak at the end of the last year, he has noticed a pattern. The market falls around 8 to 10%, then rallies by 5%, only to fall again by another 8 to 10%, before another 5% rally. Burry refers to these as dead cat bounces. But here's the kicker: he found that most epic one-day rallies in the top 20 NASDAQ and S&P 500 happened during the significant drops of the past, like the 78% drop from the 2000s top and the 86% drop from the 1929 top. It makes you wonder if history is repeating itself. To predict the bottom of the stock market, Burry considers other factors as well. One key indicator is the reading of stocks closing above their 200-day moving average. Currently, about 13% of stocks meet this criteria, but historically, the bottom usually occurs when that number is closer to 5%. This trend has been observed in previous years like 2009, 2011, and 2020, except for the dot-com crash, which primarily affected higher growth tech stocks. Second, Burry highlights the number of companies that are losing significant amounts of money. There are 218 companies worth more than $1 billion that are losing $100 million annually. Additionally, 29 companies with a market cap of $10 billion are unable to turn a profit. Some well-known names in this category include Uber, Snowflake, Lucid, Rivian, and Shopify. These figures raise concerns about the sustainability of their business models. Now, let's talk about inflation. Burry emphasizes the importance of money velocity, which represents how often a dollar is spent and recirculates throughout the economy. He explains this with an example. Imagine you spend $10 at a restaurant, and that money flows from the server to the grocery store, then to a wholesaler, a farmer, and eventually ends up in an investment. If this process occurs 5 times, it creates a money velocity of 5. Burry argues that the Fed's decision to raise interest rates takes money out of the economy, impacting the frequency of dollar circulation and potentially leading to higher inflation. Michael Burry also explains that this will be adding more and more pressure to the housing market, where 1 in 10 houses is slashing prices at the highest pace since 2015. However, there is a silver lining amidst all of these challenges. It's a great time to buy. If we exclude drops of less than 20% historically, bullish markets have lasted over 9 years with a remarkable 476% return, even including the relatively minor 20% declines along the way. The average bull market still lasts about 4 years, offering a significant 129% return. A recent Wall Street Journal article suggests we may be headed for a bear market rally. They noted that the biggest rebounds often follow the most severe falls. However, it doesn't guarantee a 2-year bull market. Look back since 1940, the shortest bull market occurred right after the dot-com crash. An oversold stock market condition could trigger a moderate rally, along with better than expected earnings. People are spending more and anticipating reduced inflation. Home builders are gaining confidence. In this market, it's essential to be cautious and prepare for the worst. However, it's unwise to base your investment strategy solely on uncertain plans. Planning for a crash has proven less effective than consistent investment through dollar cost averaging. With that said, focus on increasing your income over the next 1 or 2 years, so that even if the market declines, you'll have the resources to take advantage of lower prices. Thanks for watching, and we'll see you in the next video.